solid decisions, figure out what your potential loss is and where you might want to put your stop loss, is using candlesticks. Now, candlesticks today are one of the hottest talked about items in the markets. Now, when I started trading in the early 70s, we didn't have computers. Everything came through on ticker tape. We sat in the pits. Things would come through on ticker tape, and we would sit there with our good old-fashioned graph paper and pencils in our pockets, and we would be hand charting. Nobody used candlesticks. It was too time consuming then. It was easier to do a bar chart because when you're doing things by hand, you got to do it as fast as you can, because if you're trading, like, I sat on the Chicago Board of Exchange and I was trading agriculture, and I'm trading 10 different cattle contracts. Well, I'm charting every time the prices come through, I'm putting that on a chart, and I'm putting it on 10 different charts by hand. You need to be as fast as you can possibly be. It wasn't, now candlesticks have been around since the rice traders in the 1800s, but it wasn't until we got computerized trading that we actually started seeing candles. But those in the beginning, the candlesticks were preset, just put on the can, and you see these pretty red and greens on your chart, but you couldn't do anything with them. Well, as time moved pretty quickly, but these developers and HTML came around, we now have these charts that we can do everything on our own. And candlesticks became the buzzword in the online trading industry. Talk about buzzword. In cryptocurrency, I don't think any of those traders even know what a different type of chart is. Now, the fact is, when most traders start to learn about candlesticks, they learn what's called candlestick analysis. I'm sorry, let's back it up. They learn what's called candlestick pattern recognition. And to be honest with you, it's a big waste of your time and your brain matter. Memorizing, and there's a total of 72 number one or top level candlestick patterns, and of those, 16 are considered ultimately important. Another 32 are considered secondary, but they're very important, and people memorize them right and left. And they would memorize, when you see this, you see that, and you'd have to memorize things like dojis and hammurabis and marabuzos and bullish engulfing and bearish engulfing. And to be honest with you, in the long run, it hurts your trading. Because you get preset in your thinking that when you see this or that, you've got to do this or that. But it's not like you should know anything about it. But today, with our modern Java HTML charts, we don't even do it. You want to see bullish engulfing and bearish engulfing, you click off the little boxes on your chart, and every time a bullish or bearish engulfing pattern comes up, your chart's going to let you know it's there. But first, before we can go on to really charting, we have to understand what a candle actually is. And actually, let me pop up a live chart here for you. Okay, so what we see right now on the chart is a candlestick chart. This chart is for no other reason except it's what's on my screen at the moment. And each one of these individual candles, if we look at them quickly, we see some unusual things. Sometimes we see long bodies. This is called the body of a candle. Sometimes we see long bodies. Sometimes we see short bodies. Sometimes we see almost no body. Sometimes we see long upper wicks. Sometimes we see long lower wicks. Okay. They all tell us something. They tell us something crucial about the markets. Now, each candlestick is made up of a body. Now, remember, when you're charting, whether you're using candlesticks, bar charts, or most, you only have 4 pieces of information. You have the open, the high, the low, and the close. So for a candlestick, at the open of the time frame, you put a line across. At the end of that time frame, if the price moved up, you put a line across above. If it fell down, you put a line across below. You then put a dot, the highest point that that asset moved, and a dot at the lowest point. The open, the high, the low, and the close. You then connect the open and the close together, and you take the dots and draw them to the opens and the close. This forms your candle. These are known as wicks or shadows, and this is the body of your candle. So what's the difference here? There is a big difference between the open and the close. Here, you had a long upper wick. What happened was you had a high that was a lot higher than the open and a lot higher than the close. We also know it closed lower than it opened. So imagine this. The bulls or the buyers were able to push price all the way up there. They petered out, and the bears were able to close all the way down here, lower than where it opened, because it opened here. That tells us that the market there was full of buyers, but for some reason very weak. Now we have the body of the candle and the wicks. Now, if the open is down here and the close is up there, we would make that a green bodied candle because we stepped up from the open to the close. So in other words, it was a bullish session. If the open was here and the close was there, we stepped down, that would be a red body. Now, this is where we're not going to spend much more time on this because we're going to get on to how to analyze these, not memorize. But this is a part of the fundamentals that you should know, but you don't need to memorize. Now, we use red and green. We use red and green today because we know reds are sell, buy, and greens are buy, or reds are losses and greens are strong. But when you read about candlesticks, you're going to hear all about blacks and whites because it wasn't until recently, and I'm talking about the last few years, that we had all the candles and all these colors. Because see, when I started trading and people were starting to use candlesticks, as computers came around and we got some help with stuff, okay, what we'd be sitting there with is our pencil. And we would put a dot, dot, dash, dash. If it was a positive trading session, we would just leave the candle empty. It was a bearish session or falling session, we'd use the side of our pencil and fill it in. Didn't have magic markers then, or pocket markers. I don't even know if we had colored big pens then, but everything was done in pencil anyway. So we would call this the black candle, and we would call this the white candle. So when you read about black candles or white candle, or there's some patterns that are called three white soldiers, three black crows, this is what they refer to. Because ultimately, it really makes no difference in what color it is. Okay. A lot of brands, brokers, actually use the default on their charts as their brand colors. So in other words, I could change my candles to orange and purple. As long as I knew which color was bullish and which color was bearish, wouldn't make a difference. It would confuse the hell out of it. Sit at the bar tonight, talk to my buddy and say, yeah, well, I got that purple bullish candle, because he would have no idea what I was talking about. But if you want a pink and chartreuse, as long as you know which is bullish and bearish, that's all that makes a difference. Okay, so now the great interpreters of candlesticks would look at these candlesticks and they would see certain patterns. Like I said, dojis, spinning tops, Hammurabis, Marabuzos, and they would give definitions to them. Well, we would have to find, in the old days, we had to find them on our charts and track them down if you wanted to see them. Today, our charts have gotten really good because I can go up here and I can click on dojis. I can click on bullish engulfing. I can click on bearish engulfing, and it's going to put it right on my charts every time that pattern, whether it's a 3 pattern, whether it's a 1 pattern, but it's going to put it on my chart. And I'm going to, right here, I have a doji candle. Doji is a candle with no body. It means the open and the close were virtually the same. And the wicks are relatively the same. But we have gravestones and we have hangman, which we have big wicks in one way, big wicks in another day with. But we also have today, I don't have to even know that. All I have to do is put my marker on the candle. Now, I'm going to interrupt this. Normally, I don't stop and interrupt. I've had 3 people right in the last few minutes. Okay. I don't send, and nobody sends you recordings of a webinar. Okay. As I mentioned in the beginning, you can use the same link you used to come to this live class to see a recorded version after tomorrow. After about a week, you'll be able to find it on the Avexo website. So please don't write and say, please send me a recording. I don't sit here and email recordings out to anybody. And I already explained this to you guys. Okay. But instead of worrying about recordings, listen to the class. Pay attention to what I'm teaching, because I'm not teaching any super secret information. Everything I've shown you so far, you can find on the internet. Okay. Now, thank you very much, but thank you for attending class and listening to me. And I do want you to be able to see a recorded version of the class and watch them all you like. Now, we have all of this new modern technology, which gives us lots and lots of information, but doesn't really help us in our trading, because everybody gets lost in this. Oh, look at that. I just saw 3 black crows. I should buy. No, candlesticks don't tell you to buy. They don't tell you to sell. They give you information. Don't memorize these things. I don't memorize these. I don't have a single chart that has any name of anything on a candle. But candlesticks are all I trade with, because you can tell the story of price and use candlestick analysis to understand what the market is telling you. It's got nothing to do with memorizing these patterns, so to speak. So let's go on and talk about how you can use these candles in your trading, how we can make them worthwhile. Because also, it's very important. A lot of this was developed and works very well when the markets moved a little bit slower and you had more time to think. Today, as you know, the markets are moving very, very fast. Okay, we need to be interpreting what is happening right now in the market. And we need ways that we can easily understand what price is trying to tell us. So as I said, when Forex traders first start out, they usually learn about candlesticks. But what they learn is usually useless. They normally see a list of candle patterns like these, and they're told to memorize them. And then they're told when they see them, this is what you do. But this is not candlestick analysis, it's pattern recognition. And for a price action trader, it is ultimately useless. To think about candles as patterns is counterproductive. It makes you a worse trader. It could lead you to make massive mistakes. Why? Giving a pattern a set definition leads to tunnel vision. When you see a specific pattern, you assume that something will happen, but that's not how candlesticks work. All candlesticks need to be assessed based on the candlesticks around them, the ones next to them, the ones just developing, and their relationship to price and trends. Because what you're looking at on the screen right now is called a spinning top. But a spinning top means a reversal is imminent, which can be true. 50% of the time is going to be true. However, the same pattern can also mean that a continuation is imminent. It can mean that price is just temporarily stalling. It can mean a lot of different things. Thinking about candles as simple patterns is the wrong way to do things. You need to look beyond the patterns and use them to read the story of price. And this is where, and Alex just asked a question here. And again, I'm going to stop and answer this one because it was just about what I was going to tell you. This is where using candlesticks is better than any other kind of chart for reading the story of price. Now, as I mentioned, when I used to sit in CBOE, I was hand charting. I only use bar charts. Okay. And today it gets really crazy out there because let's go back to live chart. Okay. Because it's too easy to get sucked into this stuff. Okay. But you see this chart, this is a basic right candlestick chart, not picked for any other reason. It looks like all these other candlestick charts. Now, in my day, I didn't have all of these kind of charts. See how this whole list right here? And a bar chart was a bar chart, just like right there. Bar chart's easy to make. But you know, when I read that bar chart, I used to be able to see all the patterns and what the bar chart. Today I can't because my eyes are so used to candlesticks. I can look at candlesticks and see what's going on. I can't look at black bars and see what's going on. Okay, now, what's happened is these HTML developers, these computer developers, wonderful people, but they're not traders. And what they go back and tell their bosses, look, I can make it do this, I can make it do that, make it do that. Your boss is the marketing guy. Marketing said, great, we can tell people we can do all of these things on our charts. Well, the fact is, I don't want a bar chart in multicolors. Okay. But today you can make the bar charts any way you want. You can make that, and you can only see the high, low, and close bars. You have so many choices, okay, that these wonderful computer developers gave us that we can get lost in choices. It's like when I first started trading, and still today, a simple moving average is always based on the close period of the moving average. Today, if you want to look at a moving average, they give you, here, let's put a simple moving average up here. These charts today give you the close, the open, the high, the lows for counting your moving average. They give you high, low times 2, high, low, close times 3, open, high, low, close times 4. They give you so many choices that none of this makes any sense to anybody. But then some guru out there comes along and tells you if you do this and use that and use that and use that, you're going to make a trade that's going to get you rich. Believe me, the old basics is what it's all about. Well, we're off our tangent. Okay. The candlesticks are very nice. They're clean. They're easy. And you can easily see what price is trying to tell you. They become easy on the eyes and easy to see a story. And this is why today I like them much better than bar charts. Again, like I said, I don't care about the patterns. I care about reading the story of price in my candlesticks. So let's get on and start talking about how we can do exactly that. Okay, the story of price is what it's all about. To be able to understand what the price on your charts is trying to tell you. So think of every single candle on your chart is telling you a story. When you combine those candles together, you get the story of price. This is the foundation of my Forex or CFD trading strategy, and is reading and understanding the story of price. Reading and understanding the story of price is vital. It's vital because it allows you to answer one of the most important questions. And that's an easy question. Who is in control of price? And we're only concerned with who's in control right now. I don't care who was in control yesterday. I don't care who was in control 4 hours ago. I only care what is on my charts and moving forward, because you can't trade yesterday. You can only trade going forward. So who is in control of pricing them? You only have three choices: the buyers, the sellers, or neither. Now, being able to accurately answer this question, if you were about to enter a short trade, you want to ask yourself, who's in control of price? The answer is buyers. Well, maybe selling is not such a great idea. Now, the thing is, if you see lots of red on your chart, too many people automatically say, oh, the bears are in control. You see lots of green, you say the bulls are in control. If I were to look at these three candles right here in the yellow highlight, who would I would say was in control of the market? Well, my natural response would be the bears. Okay. But now who's in control of the market? So if you look at the three highlighted candles below, it's easy to conclude that the sellers were in control of price. But when we got this little weird candle right here, who's in control of price? This is where you're ready to trade. Who's in control of price? It's not the buyers, it's not the sellers, it's neither. It's indecision. So one might say, that downtrend is over or that uptrend is starting. What's next? Well, there's many natural responses. But you see, we're looking at it incorrectly, because just by seeing this candle that's green next to it doesn't tell us anything's happened. We need to evaluate, number one, where it's sitting. Number two, the size of the body and the length of the wicks. Now, when we see a short upper wick, a small body, and a long lower wick, this tells us we have indecision, because you could have a small body with a long upper wick and a long lower wick, or even size wicks. Okay, what is it telling you? We're not memorizing patterns. We're trying to say, well, look, the bears were able to push the price farther down, but weren't able to. The bulls were able to push it back up. They weren't able to hold it, but it still closed higher than it opened. But what it's really telling us is there's a lot of indecision. Okay. Now, what is this indecision candle? What indecision occur when buyers and sellers can gain or maintain control of price? And they're common. They happen all the time. All of these things happen all the time. But what you have to be able to do is look at each thing that is happening, and in your mind, look at it in relationship to other things and interpret what price is trying to tell you. So what is it trying to tell you? Okay, now, this is just reverse of the one you saw before. Three candles, four candles, could have been seven candles, nine candles pushing price up. And then we get indecision. Why is this indecision? Doesn't have to be the opposite color. Small body, long upper wick, short lower wick, because the wicks are reversed depending whether it's coming off an uptrend or a downtrend. But where does it occur? It happens to occur directly on a critical support or resistance level, depending on whether we're moving up or down. When an indecision candle occurs directly on a support level or resistance level. Now, I'm going to assume that most of you guys out there understand support and resistance. Let me pop up a live chart here for you a second. Now, there's a lot of stuff on this chart, and I should have taken a lot of it off because I used it for several classes. Let's see if I have something else up here. Okay, so our support and resistance lines have nothing to do with, well, it has a lot to do with current price, but they're not something we put on our charts at the moment. Support and resistance should be drawn on your charts, and they're extended out into the future. And this is prices that affected the price of this asset the last time it was trading in this range. So when price pushes up and it's moving up or down and we get an indecision candle directly on our support or resistance level, it's telling us something that's very important. It's telling us that that support or resistance level, then whether it's above or below, is working, because support and resistance levels are where buyers make decisions or sellers make decisions. Now, it's not telling you price is going to turn around and come down. It's not telling you price is going to go up. It's just telling you at a very important level that we have indecision in the marketplace. So let's take right here, for example. Price was moving up. We hit a level of resistance and we got an indecision candle. That's all we got. Nobody's made a decision. Now, but at this point, we could actually get ready to make a trade. Now, if you're trading the reversal trading strategy, you would be betting that price is going to bump off of this reversal, this resistance level, and fall back down. If you were trading the opposite strategy, you would be betting that when price formed indecision here, it's going to move up. 50-50 chance of both of them, right? Doesn't make me a genius. But when this occurs, we have an opportunity. Because if you're trading a reversal trade setup, you think price is going to go down. Now, our candlestick gives us some very important piece of information. It tells us an entry point based on where it closed here. It gives us an exit point. It gives us a stop loss point. Now, if we were to set up a buy situation with a limit order to buy on the next candle when it went below this resistance level, and set our stop loss that if it moved the other direction to close our trade, if it moved down, our trade would be executed and hopefully it would continue down. If it didn't do what we thought it would do at this point and continued up, we'd end up closing that trade with a loss. But unless it fell below that resistance level where we had set up the buy, not the buy, the sell, but set up the trade to actually execute, we would have never, if it just moved up like it did here, our trade would have never gotten executed. So therefore, we never had a loss because the trade didn't get executed. So you have a strategic point on your charts when this occurs that you can make a setup. And that's all you're looking for. You're reading price, you're looking at the setup, you're looking at how you move the odds in your favor. Well, now you have, if you're trading the reversal, you have 3 points of action. Because normally when you make a trade, price is either going to go up or price is going to go down. Okay? You can set up an execute, a stop loss, and take profit. Now, if you use a reversal trade setup or a continuation trade setup, you actually now have a price point to execute at, which is different than the price where it currently is. You have a point to put your stop loss and point to put your profit. But what happens is you have, if it doesn't ever go in the direction you thought it was, your trade never gets executed. If it moves against you and moves up, your trade doesn't get executed. If it moves down or in the direction you had selected, okay, your trade gets executed. And only if it reverses and goes back up, because it didn't go back to, do you have a losing trade. So you've got three possibilities instead of two. So you've moved yourself to a high probability trading situation. But there's many, many, many ways to set up these different trading strategies using candlesticks and other tools. So, but remember, the only time we actually have a true indecision candle, it's got to be a true indecision, is when price hits resistance, we get the indecision candle. So let's break down the story so that you understand why it indicates indecision. We have a large upper wick, the blue wick. The large upper wick shows that the buyers tried to continue the bullish trend but failed. Sellers took control of price and pushed it down. That's what gave us the large upper wick. The smallest body. The smallest bearish body shows that sellers were able to close lower than the open. This is significant because of the three candles before, the price consistently closed higher than the open. And then we have to have the small lower wick. The small lower wick shows that the sellers were not able to gain much ground either. But remember, the story I just gave you, you reverse if you're coming off an uptrend. And this is not a trend in the definition of a trend line on your. If you have 3, 5, 7 candles that have been moving up, doesn't matter if you have a red and a green, or green and a green, as long as price has been moving up steadily. So altogether, this indecision candle forming right on the strong bullish candles shows the power is shifted from an indecidedly bullish market to an undecided market. But there's one more thing we need to look at. The indecision candle is formed on the top of the resistance areas. Okay, this resistance area. We get these indecision candles 100 times when you're in a day that you're looking at charts. It's only when they form on your support or resistance areas. So remember, we talked about resistance being a sell area and support being a buy area. So in the image, we see 3 strong bullish candles heading into resistance, and then bam, push up, push up, push up, bam. So price stalls and we get indecision forming on top of that area. This tells us the sell area is working. When price pushed into that sell area, sell orders were triggered and buyers could no longer continue up. That's the story of price on this chart. And this story gives us a nice little price action setup. But all we did was read the story of price. This is one of the stories. You know, it's just like growing up as a kid. You had 100 fairy tales. They all had different princes or princesses, frogs and rabbits, but they were fairy tales. Each one of these, you have to have a basic story for, not that you adjust when you're looking at it, that you already know how to do it. You can have a half dozen reversal setups, or just wait for this one to occur. So price action allows you to take many different types of trades: reversals, continuations, range, swing, breakouts, and scalp trades, just to name a few. There's many different setups. Today, we were talking about the reversal trade setup. So reversals occur quite often, but if you do not know what to look for, then you can't trade them. So what are we looking for? The preceding trend, the indecision candle, and then the reversal trend. 3 pieces. The preceding trend, in this case, 3 down candles, 4 down candles, 5 down candles. But we see a predominantly moving market going down, or we see a predominantly moving market going up. So the preceding trend is simple. And then we get the indecision candle. But if you notice here on this one, the indecision candle is not the opposite color because it doesn't have to be the opposite. We got indecision directly on our support area or resistance, in this case, our resistance area. And long upper wick, short body, small body, short lower wick. This is the perfect setup for a reversal trade setup. See, like here, we got an indecision candle, but it's not on our resistance or support level. So therefore, it's not valid. There's nothing. It's not that it's not valid. It's not part of this reversal trade setup. We also need to look at the trends because you can't take a trade basically based solely on indecision. Okay. You need to be able to look at the trend. You need to be able to see what's happening. I mean, look at all of these little indecision candles forming here. But we have a very strong downtrend. If we got indecision here, we might have a setup. And then the reversal trend. The reversal trend is the third and most important part of this trade reversal setup. This is where you could take advantage of. After the preceding trend stalls at support and indecision forms, you often see the reversal trend. The image shows you a bearish reversal trend forming after an indecision candle. This is where we would be trading. But you can't wait for this candle to close to trade because you'll lose all of this. So where do you enter a trade though? So what you need to know is what a reversal trade looks like. You need to know that you can enter after indecision and before the reversal trend. Now, this is where it gets a little bit difficult because getting in at the right time is critically important. Okay, somebody asked, how do you determine support and resistance levels? Okay, these are support and resistance levels, have nothing to do with any of these indecision these candles, anything to do with tonight's class. In support and resistance areas are part of your knowledge of the markets. You should have support and resistance on your charts for everything. If you don't know them, you need to come to our class. We have whole 1 hour classes on support and resistance because they have nothing to do. They are already on your charts, just like a trend line, already on your charts. They are not drawn on your charts to use this strategy. They're always on your charts. Now, keep in mind, failed trades happen. There's nothing you can do about them. But getting in the right time lowers your percentage of failed trades. So many people wait for the candle close to get in. But I've tested this thoroughly, and waiting for closes gets you in too late. So where do you see? Because what happens if you waited for this candle to close, you would have lost all of the potential profit. Most likely, when it got up that far, and wouldn't have gone farther. So you need to get in right. And this is critically important about where you put your stop loss because you're going to have failed trades, but you're also going to have profitable trades. You want to make sure you get stopped out if the market decides to continue in the direction it was going when you're doing a reversal trade. So here's the perfect example. They're bullish market, indecision candle. You would set your entry point at the low of that indecision candle. You put your stop loss at the high or just slightly past the high of that indecision candle. Now, I said, so if your entry point is here, the next candle would open at the close right here. If it continued up this way, you would have never had a trade executed. If it continued down and broke this level, your trade would be executed. but you have a high probability trade, it will continue down. The only way you get a losing trade is if it continues down, execute your trade, and then moves back up. But because you stop loss so closely, you would then have a minimal loss. So it's important to keep that in mind. It's important to practice these, do them on demo accounts, just watch them appear on your chart, and then get the understanding of it and see how it works. Okay. Because whatever you're going to use, you need to be able to tell yourself the story of price. You need to understand what your charts are trying to tell you, not what the candlestick is trying to tell you, is what the price on the chart is trying to tell you. And always, always, always keep in mind risk management and risk reward ratios. So I always start out with my trend line, then my support and resistance levels. They're always on my charts. Then I look at price action. And finally, you have a last little kicker here. Look at volume to confirm. Okay. If volume is supporting your decision, you should see an increase in volume. So in trading, a lot of people tend to overcomplicate simple concepts. Sure, some of the concepts of trading are not the sort of thing you would just know intuitively, but many things are easy. You just need to know what to look for. So thank you very much for joining us tonight. And if you don't know about support and resistance, please look in our schedule and come to one of our full classes in learning how to apply and use support and resistance. Have a great night now, and we'll talk to you again real soon. Bye now.